Thank you for everyone that's hopping on a few minutes early here. For folks that joined in the last minute or so, just calling out that we'll get started here in just a couple minutes.
Hey everyone. We are 1 minute past the start of the hour. I think we're going to get started, kick things off. Um, I'll intro us a little bit, and in doing so, allocate another minute or two for folks to grab coffee or use the restroom or what have you. Um, but yeah, we want to thank everyone for joining us today for another iteration of our rental market webinar. My name is Rob Warnock, and I am a member of our economics team here at Apartment List. Um, my colleague and our chief economist, Chris Salviati, is also with us here, and he's going to be taking us through this webinar, kind of talking about the latest data that we're observing in the rental market as we kind of wind down 2025 and look forward to 2026. Um, Once Chris is finished with his slides, we'll hope to have some time for Q&A, although throughout the presentation, you're more than welcome to drop your questions in that Q&A window. I believe the Q&A window is where we want to be taking care of that today, as opposed to the chat. So I'm going to be online here, kind of monitoring the Q&A, answering questions as I can on the fly, and saving the bigger ones for Chris at the end. So once again, we appreciate everybody for joining us today. And with that, I'll hand it over to Chris to get started with the presentation.
Awesome. Thanks, Rob. Appreciate the intro. And as Rob said, thank you all for joining us, taking some time out of your day. I know schedules can sometimes get a little bit busy this time of year, trying to close things out, which crazy to me, still does not feel like we are at the end of 2025, but here we are. And given that that's where we are, that's sort of how I've structured this presentation is to take a look back at where all of our key metrics on the market are closing out the year, a little bit of a year in review. And then I want to preview a new data set that we have coming out to add to our kind of suite of indicators on the market. We'll be launching that in early 2026. And then the final section here, I'm going to take a little bit of a look forward into, what we're expecting the market to look like next year. So lots of content to dive into in a short amount of time. So I'm going to go ahead and jump right into it. Well, we start off with rent growth, and the TLDR here is that we're in the midst of another pretty sharp winter cool down. Rents fell by 1% month over month in November. That was the sharpest single month decline that we've seen in quite a while, actually, going back to winter of 2022 when these kind of softer market conditions began to take hold. That was the last time that we saw a month over month dip, sharper than what we saw this month. And that we've now been seeing rents fall over the past 4 months. And so if you add that all up, that kind of continues this pattern that we've been on over these past couple of years of seeing the peak season, what is typically the peak season, the spring and summer moving season, actually fairly moderate rent growth, followed by a sharper winter dip in prices. And that's kept our year over year growth rate of our national rent index in negative territory. Dipped slightly this month down to 1.1%. The national median rent today, 1.1% cheaper than it was 1 year ago. Again, this is the third straight year that we've closed out with negative rent growth to close out the year. So for the third straight year, prices are closing the year slightly below where they started the year. This number had looked like we were getting ready to flip back into positive rent growth earlier this year, but now the market has actually cooled, if anything, back down a little bit further over the past 6 months. A lot of that, I think, having to do with the demand side of the market, some labor market softening that I'll talk a little bit more about later in the presentation. But TLDR here that this was another year, 2025, where rents continued to dip. When we add up all of those past 3 years now that we have of kind of softer rent growth, the median rent nationally now about 5% below the 2022 peak. And you can see in this chart, this is just showing the actual dollar value of rent, and we've added in a dotted line here, which shows sort of what that pre-pandemic trend would have looked like if we had just stayed on that pace of kind of slow and steady rent growth that we were seeing. Skipping a couple slides there. So the dotted line showing how that trend would have looked if we had maintained that slow and steady 2.5, 3% rent growth pace that we were on from 2017 to 2019. We're still slightly above where that estimated projection ends up, but only just barely. So despite kind of that skyrocketing rent growth that we saw in 2021 and the first half of 2022, we're now getting back to pretty close to where things would have been if we had just remained on that slow and steady path. So still, the past few years of softness have not kind of entirely erased that big spike, but it's getting us much closer now to being sort of in line with that longer term trend. Of course, tons of variation regionally. This map showing metro level year over year rent growth. And you can see huge swing from the market that has seen the fastest rent growth, which is Providence, Rhode Island, plus 5%. At the other end, Austin down almost 7% year over year. So you've got basically a 12 percentage point swing between the hottest and the coolest market right now, which is a pretty widespread. It just tells you that, underneath the hood of all of these national metrics, it's really important to keep tabs on what's going on locally. When you look at the markets that are coolest right now, a lot of this does have to do with this supply glut that we've been working through over the past couple of years in many of these Sunbelt markets. Austin, really, again, kind of the prime example there, just building far more quickly than any of the other major markets. But Denver, Tucson, San Antonio, New Orleans, a little bit of an exception there, not building quite as fast as some of these other markets. But really, the top five that you see in that list there, and really, if you look at the map, you can see a lot of the markets throughout Texas, Florida, Arizona. Even when you get into some of the Carolinas, Charlotte, for example, another good example here. A lot of these markets that are just building a ton and seeing rents kind of cool off right now. I think actually, the long-term fundamentals for many of these markets still look quite good. The reason that many of these markets have been building so much is because there's been strong demand and lots of folks looking to move in. to these places. And I think what we're seeing now is just kind of maybe a little bit of a timing issue where a lot of that supply is hitting right at the time where the demand has maybe pulled back slightly. Over the longer horizon, I would expect these markets to kind of normalize. And the other important piece of context here is that most of these markets that are seeing rents dip most sharply right now are also the same markets that have seen some of the fastest rent growth. If you look over kind of a longer, the past 10 years type horizon. And so, in some sense, what we're seeing here is just a little bit of a normalization, I think. Obviously, not kind of maybe the best news if you're an operator this year in one of these markets, but I do expect that that longer term things will kind of even out there. And then when you look at the markets on the other end of the spectrum, Providence, kind of an interesting example there. I think we're seeing this in some of these mid-size, maybe secondary markets is a term you might use. I don't, maybe folks in Providence might take offense to that, but I think, the idea here being that Providence kind of sits on the periphery of Boston. It's a much more affordable market compared to Boston. And as we've seen the rise of remote and hybrid work arrangements. I think we're seeing folks in some of these really expensive markets expand their searches outward in search of affordability. And so a market like Providence is one that has really gained a lot of renters for that reason over the past few years. And Providence actually, even if you look over a longer horizon, over the past 5 years, fastest rent growth over that extended span as well. Rents there up over 40% over the past 5 years. So really, that kind of that affordability gap that is maybe driven some of this demand into Providence. It has definitely shrunk actually quite a bit, but still an area that is more affordable than the more expensive market nearby. And we see kind of similar dynamics, I think, with New York and maybe some of the Connecticut markets. In the Bay Area, we see similar things. So that's definitely a trend to keep an eye on. And then speaking of the Bay Area, San Jose and San Francisco rank second and third here for fastest rent growth. A lot of that, I think, having to do with a surge in demand driven by the AI boom. That isn't the whole story. We're also seeing kind of just a longer term, more gradual shift back to these markets after a few years where they were some of the places that saw the biggest kind of out migration due to remote work. It isn't solely kind of new jobs created by this AI boom, but that's definitely part of the story. I think we have all heard a lot about AI in recent years. We might not necessarily think about it particularly from the standpoint of housing markets, but in the Bay Area, it's causing a big shakeup here. And then Chicago and St. Louis, I think a lot of these Midwestern markets maintaining kind of that more slow and steady positive rent growth, and again, maintaining a little bit of an affordability advantage over other parts of the country that I think has boosted demand over the past year. On the occupancy side, we are seeing things continuing to soften. So even though this surge in construction and new supply hitting the market, that has slowed this year, but occupancy has not really reversed tack here. Right now, our national vacancy rate at 7.2%, the highest we've ever seen in this time series. That goes back to 2017. So it's not a huge history that spans multiple housing cycles, but at least, over the past 8 years, this is the highest vacancy rate that we've seen, and actually continuing to trend up even as that wave of new supply has begun to recede a little bit. We see this similarly in our time on market indicator, also showing this softness in the market. Our list to lease time right now at 36 days. You can see, looking back, that this is a data set that has quite a bit of seasonal pattern to it. So, similar to our rent growth estimates, in the summer when rent growth is fastest, more people looking to move. That's when units are turning most quickly. And then in the winter off season, units tend to sit a little bit longer. January is typically when we see this list to lease time peak. As of November, we were at 36 days, which is not an all-time high, but it is the highest that we've seen in November. And so it's looking like over the next couple months, if this continues to increase as we expect it to, we might hit another peak in this indicator as well. And then finally, just to say, spend another minute on seasonality here. This is kind of an interesting pattern that we've observed in recent years that the shift of when the peak moving season has maybe started to even out a little bit. Typically we would see peak rent growth occurring in May and then rents not beginning to actually dip until September. Over the past 3 years, what we've seen is consistently peak rent growth actually happens in March, and then things begin to taper off, and we actually see prices begin to dip in August. Some of that, I think, just reflects kind of the fact that we've been in a really soft period for the market. But I do think this also reflects maybe a little bit of a shift in the timing of when folks are moving. We're also seeing similar patterns in some of our search data, the preferred lease dates that folks give us when they register for apartment list, as well as when we see the highest number of registrations on our platform. Still the case that that the late spring and summer months are the peak, but not as high of a peak. That's beginning to flatten out and be a little bit more evenly distributed across the year. So that's definitely something to keep an eye on going forward, as we've now got 3 years running of that pattern playing out in our data, and I think we are expecting that that's going to continue going forward. Okay, so moving into the second section of the presentation, this is sort of a continuation of what we were just talking about in the sense that, we're still looking here at what I would refer to as kind of key indicators on the market. But I wanted to break this out separately because this is a new one that we're adding to the presentation. We haven't shown this before, but it is something that I think we're expecting to be presenting on going forward, and that is concessions. I think probably, a lot of you, especially if you're operating in one of these Sunbelt markets that we talked about, Austin, Phoenix, Denver, you've seen that offering rental concessions has become more and more common over the past couple of years as the market has softened. We're seeing actually that, even over just the past 5 to 6 months, this has seen a meaningful uptick. And so, right now we estimate that nationally, 35% of properties are offering concessions. And the way that we've defined this metric, we're actually only considering concessions that amount to 1 month or of free rent or more. And so, that kind of accounts for different formats that those concessions might take. Sometimes it's marketed as, 1 month free. Sometimes it's marketed as 4 weeks. Sometimes it's marketed as a dollar value that equates to that 1 month. But we do, kind of go into that data and clear out some of the lower dollar value concessions only to consider kind of these more valuable ones. Right now, again, more than 1 in 3. That's up from about 1 in 4 late last year and early this year. And again, over just these past 5 months, we've seen a meaningful uptick, coinciding really with when our year-over-year rent growth started to dip further negative, when we've seen that list to lease time start to spike again. And so it does seem that we are closing out the year with things actually, if anything, getting a little bit softer rather than starting to strengthen, which is what maybe, at the outside of this year, I think is maybe what we had expected. When we were talking about this even kind of a year ago in 2024, I was hearing a lot of folks kind of mention this catchphrase of like survive to 25, things like this, that this was the year when we were expecting supply is going to pull back and we're going to see the market start to tighten again. That really hasn't actually played out. Again, I think a lot of that due to demand maybe being a little bit weaker than what we had expected. When you break this out on a market by market basis, uh, it's really kind of similar story to what we were seeing in that rent growth map. The markets in the South, really the ones with the highest concession rates, and then a lot of these kind of Northeast, Midwest, some of the West Coast markets, not having to lean on that as heavily. Denver right now actually is the market offering the highest share of concessions, 58%. So really, really common in some of these markets. That top five, all above having more than half of properties offering at least 1 month free. And in some of these markets, it's even more. So here's a little bit of a spotlight on Denver, showing some of the live specials that we're seeing right now. And you can see in some cases, this is up to 3 months free base rent being offered in some of these markets that are experiencing the softest conditions right now. So really, an indicator, like I said, that I think demand is a little bit soft, and we're really seeing operators having to kind of pull on these levers to bring in demand to fill their units. So that's where we're at to close out this year. But where do we think things are headed next year? That's what I want to close out on here in the last section of this presentation. And I've got 5 slides here, kind of structured around, again, some kind of key storylines that we expect to be defining the market going forward. Number one, this construction boom that we've been talking about is going to continue slowing, but it's not falling off a cliff. We actually are continuing to see pretty robust supply. This chart showing the total number of multifamily units completing construction in each quarter, going back to 2018 to give a little bit of historic comparison there. And you can see we've got kind of our forecast in there through late 2027. You see the huge spike in 2024. Most units delivered since the mid 80s, over 600,000 units hit the market last year. This year, we're headed towards something that's looking more in the range of 500,000 units. So that's a really, it's kind of an interesting middle ground where it's a really sharp pullback compared to where we were last year, but it's still much higher than any other year prior to last year, going back again for a few decades, actually. So even though we've seen this sharp pullback, I think what folks were kind of maybe not giving enough credence to is this idea that it's not just a matter of kind of getting past the peak. It's that once you're past that peak, you're still at a pretty high level even as we're on that down slope. And so it's taking us some time to get down past that peak and back to something that is kind of more in line with that longer run average. I think 2026 is when we start to fall back to something that looks more like kind of the 2015 to 2019 average, but even that was still considered a pretty healthy level of construction. And so again, we're not seeing construction stop, we're just seeing it slow. And so with that combined with the fact that we still have a lot of units that are on the market getting absorbed, I think the demand side is going to be the key factor in how the market shapes up next year. And I think kind of the maybe not great news on this is I think that we have some reason to think that demand might continue to be a little bit soft next year. A lot of this having to do with the labor market. So this chart is showing job creation on a monthly basis going back over the past few years. You can see that, we had earlier this year a big downward revision to the prior year of estimates here. That data always gets revised annually, but in this case, that revision happened to be downward, happened to be a pretty sharp one. And so now you can see that we've really had basically since the second quarter of 2024, job growth coming in well below the longer run average, and particularly in recent months, the most recent jobs report came in a little bit stronger. But then we're also seeing some private market data from ADP, which is kind of a leading indicator on the official government stats. That's continued to be pretty weak, and so it's looking like the labor market is certainly a bit shakier than where we thought it was to start this year. And that's a key corollary of housing demand. When folks are not feeling as confident in their job prospects, and their job security, they're less likely to go out and form a new household. And so I think this could be a key storyline in multifamily going forward to next year is just demand maybe being a little bit soft, less of particularly those kind of young folks striking out and starting new households. The upshot of that, I think that, we're actually going to see that occupancy and pricing are going to remain a little bit soft this year. This chart showing our forecast of the national vacancy rate going through the end of next year. We are expecting it to sort of stabilize, so it's not necessarily that, that we're expecting to see conditions kind of get worse in terms of occupancy, but we're also not expecting them to get meaningfully better. Right now, where our forecast calls for 2026 to close out still just above 7%. So ending really pretty much right about where we're at present day. So not a lot of improvement there. Again, this varies a ton by market. So this kind of soft national picture really driven by some of those pretty soft Sunbelt markets. Another trend I want to call out here, that I think is maybe not something that we always talk about a ton in multifamily, but I think is something that should be top of mind, is that single family rentals in recent years have been really kind of a much more important factor in the rental market. This chart showing the share of all new single family homes being built that were specifically built to rent. That was more than 1 in 10 in 2024, much, much higher than it's been historically. And as we've seen in recent years, that a lot of the demand for rentals has actually come from folks that maybe under different conditions would be buying homes. That we as much as rents have increased in recent years, home prices have increased much more quickly. Combine that with mortgage rates, it's really been a very difficult time to break into the for sale market. And so a lot of folks that are potential would-be first-time home buyers have remained in rentals for longer. But that doesn't mean that those folks aren't still looking for that single family type lifestyle. And so that's, I think, where we've seen this really big spike in single family rentals. So this is an important thing, I think, for our industry to keep on the pulse of, because this is a segment that I think is going to increasingly be offering kind of a new segment of competition for traditional multifamily rentals. And then my final prediction here for next year is that I think we're going to be hearing a lot about some local politics in terms of rental markets next year. As much as I've been talking about the market being soft over the past couple of years, rental affordability is still a really big issue for a lot of folks, particularly in the nation's biggest markets. And so we're seeing folks really kind of demand solutions there, and that's playing out in some pretty high profile ways. I'm sure we're all familiar with Zoran Mamdani in New York, having recently won the mayoral election there. His platform included an important element around, I mean, really his entire platform was around cost of living being the core of that, and housing being a huge component of it. He's had a proposal to put a rent freeze on rent stabilized units in New York. We also just saw kind of something, sort of a different tack, but kind of attacking a similar affordability issue in San Francisco, where the new mayor here has recently got through a plan to upzone the city to try to address affordability with new supply. We've seen recently a rent cap also taking place in LA. In New York earlier this year, we had the FAIR Act, which was intended to eliminate broker fees from the renter side of the equation. Something similar happened in Boston earlier this year. So a lot of this stuff where, we're seeing kind of local voters demanding solutions to housing affordability and local politicians responding to that. I think, we're going to see some of these things play out, get a sense of what their impact is in 2026, and I think that'll tell us a lot about where the future of some of these solutions are if some of these things get expanded into other markets going forward. Okay, so I know I've already ran a little bit long here, so I'm going to stop there. If folks are able to stay on for another couple minutes, I'm happy to take a question or two if there are any of those in the backlog, Rob.
Yeah, thanks for all the info, Chris, and thanks again for everyone for joining us. A couple questions did come through that I wanted to ask you about. If we've got a couple minutes here. One was with respect to rent concessions and just confirming that a lot of these concessions were being offered for new leases versus lease renewals, and if that plays a role in the calculation of rent changes in a given market.
Yeah, those are great questions, and yeah, the kind of the methodological answers there. So on the first one, we're looking at concessions being offered on new leases only. So these are not necessarily applying to renewals. They may be also applying to renewals in some cases, but that's not specifically what we're looking at. We're looking at new leases only. And this data set is separate from our rent estimates. So those concessions do not explicitly factor into our estimates of rent growth. So when you do kind of combine the picture that those two data sets are painting, our estimate of how much rents have dipped over the past year, if anything, we might be understating things when you account for the fact that more and more of these units are offering a month or two free.
And then another question that came through was whether we had any sort of like more localized, whether it be by region or by state, a more like localized look at some of these predictions that you presented here in the last third.
Yeah, we don't formally have all of those kind of forecast numbers that I showed, the estimates for new units hitting as well as what occupancy might look like. We don't have those formally forecast on a market by market basis, but I will say that in general, I think the broad strokes of what we saw this year and what we've really been seeing for the past couple of years, I would expect those same regional trends to play out next year, where it's going to continue to be those Sun Belt markets that are going to have the most new supply sitting and consequently probably have the softest conditions. And then on the flip side, some of those kind of lower supply markets may be maintaining a little bit more resiliency in terms of pricing and occupancy. Some of the job numbers, I think that could vary a bit too. I think we've seen, like I said, in the Bay Area right now, this is where a lot of these AI companies are based, and so it's actually been kind of a bit of a boon to the local job market here. We could start seeing next year really might be the year where we actually start to see AI actually taking a bite into job growth. And so some of the, if your local economy is kind of centered on jobs that are most at risk of having kind of some of that AI creep in, then that could be a factor hitting on demand as well.
Great. Well, I think that about wraps it up. I want to thank everybody again for joining us and for sacrificing some of their Tuesday afternoon to listen to us talk about the rental market. Yeah, with the last slide that Chris has got up, just some links if you want to see some more of our work from the econ team, or if you want to get in touch, if you have any specific questions you would like to follow up on or request for data or anything like that. Research at Apartment List is the place to send a message that'll go to Chris and I. Otherwise, we'll follow up after this with a link to a recording of the presentation and a brief survey about how we can continue to make these better. So we appreciate any participation there. Otherwise, I hope everyone has a good remainder of the holiday season, and we'll be back in the new year with some more data. And until then, take care. Thanks again, Chris.
Thanks, everyone.